My next guest says he's managing his five-star portfolio as if rate cuts aren't coming until 2025. Let's bring in Kevin Simpson of Capital Wealth Planning. Wow, so nothing next year's coming from the Fed in terms of cuts?
It'd be nice if I'm wrong, because rising tides will lift all ships. But I totally agree with you, Scott. The way I interpreted Chairman Powell's remarks today seemed almost identical to what we saw when the market looked at it as the most dovish speech they'd seen. So we all come on and we talk and speculate about rates and cuts and everything else. But what I tend to do is I like to look at smart people who are actually in the marketplace, people who are issuing debt and who are paying interest. And we always talk about the fact that the bond market itself is typically a lot smarter than the stock market when it comes to predicting rates. So in the FT this morning, I mean, they had an amazing analysis on Pepsi Cola. This is an A-plus rated company that went into the debt market yesterday. They raised $2.5 billion worth of debt, of which $1 billion, Scott, was variable short-term, one-year note. And that means that they don't see the Fed coming to the rescue anytime soon. It also means they don't see a recession for the next year, which is a subplot that's kind of interesting. But the most compelling statistic is, hey, the Fed's not lowering rates. If they thought that, they would hold off. And for that reason, you know, we're in the business of wealth preservation. We're not in the business of speculation. Mm-hmm. So I need to manage the portfolio as if higher for longer is real. The Fed's not cutting rates, that these targets are all, you know, wishful thinking, and that we've got to prepare for a market that's going to have higher rates until the beginning of 2025.
All right, so let's talk about how to do that then, in terms of manage a portfolio correctly, if you're right. You added to Cisco. Why?
Yeah, I think the thesis for that year, if I am, is that you need to just look at cash flow. And we're looking for companies. We started to build this position in the end of September. It's not an AI play at this point. Perhaps the Splunk acquisition will allow them to get into that space. But you've got a 2% dividend, a 5% dividend increase, pretty consistent year after year. Their earnings are up. They have just ample, fortress cash in their pockets, which will also help finance the Splunk acquisition. But their numbers have been good. They report next Wednesday. I expect them to be good as well. I don't know that the stock will go on a tear because, again, it's old school tech. It's not AI.
Okay, you started a new position in the CME group. Tell me about that one.
Yeah, this is a stock we've owned in the past. It would have been nice if we've had it for most of the year. It's done really, really well. But what I like about it is that they've had 9 quarters of double-digit earnings growth, 9 quarters of 9% revenue growth. This is a stock that is the margins are incredible. The PE is a little high, 23 for us, 24 forward. But historically speaking, that's on the lower end of how they've traded. And what I like best about it for investors, it pays a 2% dividend. It just increased that by 10% last quarter. But at the end of the year, they tend to give us a gift, a special holiday dividend. Last year, that was $4.50, Scott. Now, there's no guarantee what they're going to do this year, but just based on how profitable they've been in 2023, I would expect something similar. And just back of a napkin math, that makes the yield close to 4% on a stock with an incredible growth trajectory. So we like this space. Obviously, we're traders, so the CME is near and dear to our heart. But I think it's an investment that, from a cash flow perspective, will continue to do well for the next several years.